metric that you use, I'll open up to Freeberg and then everybody else, to know that the market is overheated? Freeberg, is there something you look at and go, okay, we've disconnected from reality? Price to earnings, price to sales, some valuation metrics are the things you look for. So you know that this is overheated and maybe it is time to pair positions. What have you learned over now our third collective down market?
Valuation trophy hunting, I would say, is a pretty good indicator of things being
explain what that is.
In a heated market. Like if the businesses, the CEO, the founder, the venture firms, everyone is all about how much you can mark up your investment as opposed to talking about the quality of the business and the quality of the earnings. And then you revert back, as we just recently did, to now people talking about, okay, how strong are the gross margins of this business? How effectively can they deploy capital? What's the return on invested capital? Key metrics around the fundamentals of the business versus the value that the market is willing to pay for the business. And the more heated the market gets, the more everyone focuses on terms like unicorn, decacorn, and that becomes the key metric, as opposed to saying this business is so good. For every dollar they spend, they make $3 in gross profit in 12 months. That's what fundamentally says that's a high quality, a valuable business over time, as opposed to here's what the market is telling me it's worth today. And if the market is telling you it's worth that much today, and that's what you focus on, you inevitably end up in these kind of bubbly moments where you miss out on focusing on core value creation, which will actually pay off much, much more over time.
Chamath, you pointed out another signal. Hey, when smart people who have the largest amount of capital in the markets are clearing positions, maybe that's a signal of a top. And then I think is a really good insight by Freeberg when the conversation, the narrative is about the valuation and the status and vanity metrics as opposed to the quality of the earnings. Hey, that's a really good indicator we're in a bubble. Maybe you should start clearing positions. What are indications for you that we're either in a bubble or the market is undervalued? Because we're really talking about this timing, right? Timing is very important as a capital allocator.
It's not possible. This is why I think that you have to define what game you want to play before you start playing the game.
Okay.
This is why I think it's kind of nonsensical. For example, I believe that at best, I am an equity investor in technology companies or things that have a technology bias, because I can generally understand them maybe, a few seconds faster than everybody else, which allows me to make a decision a little bit quicker. But if all of a sudden I started investing in debt, you should expect that I'll lose my money because I don't know what I'm doing. And that's not the game where I have any advantage. So I think the most important thing to do is to not try to do all of this crazy stuff, because this is what happens in moments where either things are very, very good or things are very, very bad. People try to create all these stupid rules. And their only rule is there are no rules. So I don't know. I just think it's like, stick to your knitting. If you're a product builder, build products. If you're an early stage investor, just do that. It's hard enough to do any one of those things really, really, really well. But this idea that, you're going to come up with like some mosaic in a system, I think it's just highly suspect. And I think the market returns have showed that everybody that tries has failed except for maybe one or two.
Sachs, any thoughts on this?
It's just not going to work. What's the point? So I don't know. If you're an early stage investor, make good deals and then give the shares and book the win.
That's what I do. Yeah, that's my philosophy. Sachs, what are your thoughts?
There's a couple of metrics that I'll be looking at from now on that I wasn't paying a huge amount of attention to before. One is the price to ARR of the median public SaaS company. And so like Brad Gerstner has these great charts where you saw that historically that number was around 6. The median SaaS company was trading at about 6 times their next 12 months revenue. And it went all the way to 15 during this sort of COVID bubble in 2021. And for the high growth SaaS companies, which are the ones growing 40% instead of 20%, it went from, like 8 to 35. So I'll definitely be looking at that. And, what you're looking for is just how off the historical mean are we, positively or negatively, because these public valuations are the exit comps for the private markets, and those valuations do eventually trickle down. And so if there is a bubble in the public markets, it will trickle down to the private markets. So that would be like one metric. I mean, again, it's not something that like affects me daily, but it's something I'd want to periodically keep tabs on. The other is just interest rate policy. I mean, I've never spent so much time in my entire career like looking at inflation and interest rates than I have this year, because who knew how much this stuff was affecting us? I thought I was a micro investor. I thought I was just picking companies on a micro level. As it turns out, we were all massively impacted by macroeconomic policy. And, it got so we didn't even notice it. The zero interest rate policy, the ZIRP, along with the quantitative easing, these were supposed to be exceptional measures that started back in 2008, but we stopped noticing them. They continued for years and years and years. They continued until last year. And we just stopped noticing because we got used to it. We kind of got hooked on drugs. So the market did. So I'm just going to have to pay a little bit more attention to what the Fed is doing now. And, if you go all the way back to the dot-com bubble, what's interesting is that the Fed funds rate back in 1999 wasn't low. It was like 4%. It wasn't like it was even today. And we still had a bubble. But what popped the bubble was that interest rates went from 4 to 6% from 1999 to 2000. That's what popped the bubble. So, I don't know if we'll ever have a situation again like we had over the last few years with the ZIRP. But that probably looking for that next time is fighting the last battle instead of the next one. But you do probably have to be a little bit more aware of monetary policy and what the Fed is doing.
Yeah, this chart, Exhibit 6 from the Vision Fund benchmarking against peer funds that Chamath just put into the group chat is absolutely spectacular. It puts Sequoia Insight and SoftBank, large funds against each other. Fund size, $100 billion for SoftBank, $8 billion for Sequoia, $6.3 billion for Insight. And to Chamath's point earlier, the pace is really crazy. 130
deals per month. But then the average check size is 620 million.
Versus 130 and 70. And the deals per month, 3.5 versus 0.6 versus 4.2. So Insight going pretty fast with small checks. SoftBank going very fast with huge checks.
Is really, Sequoia has the benefit of being able to backtest against 40 years of returns. And so if essentially what they're saying is there's really no more than 5 or 6 companies a year that are worth investing in, that's a really big signal that's worth thinking about. And so, 5 or 6 companies, maybe they can absorb even $600 million each. It still puts you at $3.5–4 billion. Doesn't put you at 20, which is what you need to put 100 into the ground in
$2 billion a month. I mean, my Lord, it's like Brewster's Millions or something. It's like some crazy premise.
I think in fairness to SoftBank, again, these are the same guys that invested in Yahoo. They invested in all of these, .com companies and brought them into Japan, including great businesses like Cisco. These guys have been big time serial winners. I think the tactical mistake was not having a 10-year investment life.
I mean, and we could be sitting here next year. Alibaba could double in value. A couple of their other positions could recover 50%. Okay, but we could be sitting there and they could have closed the gap massively.